US small caps rise or fall on the domestic consumer, so can they keep rising now? This is Sectors Up Close, and we're talking US small caps. The Russell 2000 fell nearly 30% between November and April on concerns the US economy could be weakening. But since the Trump administration delayed its steepest tariffs for 90 days in mid-April, it's back up over 20%. Nathan Moser is a senior portfolio manager at Impax. Nathan, these stocks really ride on whether Americans feel confident in spending money, don't they? So what makes you think they will keep spending going forward?
Well, thank you for having me. I think a lot of it does come down to the economy and whether or not the U.S. will enter a recession or not. If you flash back to April, with the worst fears around the tariffs, odds of a recession increased to likely more than 50%. As we sit here today, those odds are much lower because the worst of the tariffs have likely been taken off the table, and investors are increasingly expecting fiscal stimulus to likely impact later in the year of 2025 and into 2026. So while I know many investors are frustrated with small cap performance, they've lagged for more than a decade, valuations are so compelling that we're recommending that folks stay invested in the asset class.
Just to dig into that point on tariffs, you said they've been taken off the table, but those higher rates, of course, were only suspended for 90 days. So shouldn't the market be concerned that they could be back as soon as early July?
Well, that is a risk. And again, the 90-day delay implies that at some point here in early July, we're going to see tariffs back on the table. I think many folks have discounted, yes, we will have higher tariffs, but the eventual rate for most countries, excluding China, will likely settle in the 10 to 15% range. I think the key point from a company perspective and then for earnings is that many companies are going to have to absorb some of that tariff impact as the US consumer really can't handle additional price increases, just given the softening economy that we see.
I know that within small caps, you wanted to pick out financials, America's smaller banks, which have performed fairly poorly in the last couple of years. Why are you picking them out now?
Well, they had a great run after the Trump election in November. They've given a lot of that performance back of late. Really, the catalyst for small banks to perform better is a lighter touch from a regulatory standpoint. Regulation disproportionately impacts smaller companies. The large banks that many viewers will know well, they tend to navigate regulation better than the smaller community banks. So we expect that lighter touch to be supportive. We also expect there to be an increase in M&A activity as banks are allowed to actually pursue mergers. We're seeing some signs of that already. And the timetable to get deals done and get them closed is months, not years, which increases confidence of their management teams and their boards.
Is there a risk, though, Nathan, that lighter regulation could mean another Silicon Valley bank?
I don't think regulation's going to, the pendulum's not going to swing all the way to that extreme. You have to remember that, especially with the smaller banks, these executives and these board teams tend to be quite conservative. This is basic banking for Main Street America, lending to small businesses, lending to homeowners so they can purchase homes. They're not doing exotic things. Silicon Valley Bank was the exception to that. The majority of the 4,000 plus banks in the United States tend to be quite risk averse.
How rate sensitive is this sector, Nathan? Are potential gains reliant on moves from the Fed?
That's a good point. The yield curve has definitely helped. When we had an inverted yield curve, that was a headwind to bank performance. Now the yield curve has moved into a more normal position. With respect to the Fed, we're nearing the point where the Fed will be able to cut interest rates. Investors, in fact, are turning their attention to next year when Fed Chair Powell's term ends in May, and the prospect of another leader of that institution being more dovish and actually maybe being a bit more aggressive with lowering rates, that would be supportive as well to the banks broadly.
You said you expect M&A consolidation in this sector, so presumably not all smaller financials are a good bet. How should investors pick and choose?
Yeah, that's a very good point. So I think, as with all investing, you should be selective. Our preference is to position in geographies in the United States that are seeing in-migration. So that's broadly the southern states within the U.S. specifically areas like Texas and Tennessee, to name a few. Those states are seeing stronger economies. And again, as folks move from northern states to those states, they're bringing their assets and they're bringing that economic growth with them.
That was Nathan Moser of Impax. Don't forget, you can watch more videos on Reuters.com.